Hi there, Claire Smith here from StablePoint Partners, and today I'm excited to be walking you through what you need to know about Roth IRAs and Roths within your portfolio and tax plan. We get so many questions about Roths, and we're always utilizing them for clients where we can. And I'm genuine when I say I'm excited because Roths are so beneficial and an awesome long-term tax saving vehicle when it makes sense for you. So let's jump right into it. So what is a Roth IRA? IRA standing for individual retirement accounts. And I mentioned it's one of the best retirement savings vehicles. And we'll get into some details about why that is and also some caveats there too. So Roth IRA contributions are made after tax. Unlike your 401k or traditional IRA, for example, there is no tax deduction. However, when your money comes out in retirement, that is completely tax-free. Unlike, again, a traditional IRA or 401k, where that is all taxable income to you when it's withdrawn. Again, there are caveats to this. There are eligibility and contribution limits. The contribution limit for any IRA, a Roth or a traditional IRA, is $7,000 in 2025, or an additional $1,000 if you're over 50 years old. There are also eligibility limits based off of your income, and we'll get into the details there, but basically, if you make too much money, you can't make a regular contribution into a Roth, but we'll go over strategies if you are over those income limits as well. Something for both traditional and Roth IRAs to remember is that these are outside of your employer retirement plan. You can contribute to your 401k, 403b, 457, and you can also contribute to an IRA. And then both of these do grow tax deferred while money remains in the account. So no capital gains, no interest or dividend taxes there. So let's jump in a little bit more into the differences between a traditional IRA and a Roth IRA. Just to reiterate, a traditional IRA, like your 401k, is made with pre-tax contributions, and you can get a tax deduction right away. Again, limitations there as well, versus the Roth IRA, which is again after tax contribution, no immediate tax deduction. We went over that you're taxed at withdrawals for traditional and not for the IRA. One big difference is also the required minimum distribution. So for a traditional pre-tax IRA, Uncle Sam wants its money back eventually. You got your tax deduction on the way in. They need that to be paid back to eventually. Right now, that age is 73 for needing to make required minimum distributions. That does not exist for a Roth IRA. That was made after tax, and so there is no withdrawal requirements there. To reiterate, there are no income limitations for a traditional IRA to contribute there. Same with your 401k. However, for a Roth IRA, this is where they limit who can do this. And if you look in the orange below here, the 2025 income limits to be able to make a $7,000 Roth contribution. If you're single, if you make under $150,000, you can make a full contribution. And if you're married filing jointly and your joint income is $236,000 or under, you can make a contribution, and then it fully phases out at those higher limits there. One last important distinction is that with a traditional IRA, you are fully taxed and penalized 10% penalty on any early withdrawals before age 59 and a half. The difference with the Roth IRA is because this didn't go in pre-tax, is that you can withdraw your contributions at any time without penalty. And that's just your contributions, not the earnings in the account. So moving on to really, what is the brass tacks? That's a lot of information. Why am I really doing a Roth IRA versus a traditional IRA or vice versa? And really what it comes down to is when you get that tax deduction or tax break. With a traditional IRA, you get that tax break now. So if you're in a high income bracket, you're going to want to lower your taxable income right now with the expectation that in retirement, your income tax bracket is going to be lower. On the flip side, with the Roth IRA, is that you forego the deduction right now, that grows completely tax-free, and that bigger amount comes out tax-free in retirement. Let's give an example of everyday life, this difference working out, the tax break now versus later in real dollar amounts. So the example that I use here is if you were to contribute $10,000 into a pre-tax account versus a Roth account. So right now, if in the pre-tax account, you would lower your taxable income by $10,000, not your taxes by $10,000, just your taxable income. And then in the Roth account, there would be no deduction now. So really, you just move this over from your bank account or your brokerage account, and that would be that. Let's say 30 years goes by and that $10,000 grows to $100,000. And in retirement, or over 59 and a half, you go to withdraw this amount. The big difference here is that in the pre-tax account, $100,000 is completely taxable income to you. So if you're at a 25% tax rate, you net about $75,000 versus in the Roth IRA, you withdraw that full amount completely tax-free. So that's really where, if you look at the numbers, you can truly see the difference there. And if we move on, so some clients often ask, where does this fit in with your workplace plan? At work, you have the sponsored 401k, 403b, 457 plan that I mentioned. The difference is that one, they're completely separate and they have different contribution limits. You have a much higher contribution limit in the employer plan, and that's at $23,500. And it depends. There are different types of employer retirement accounts as well. But the IRA, again, that limit is $7,000. 2025, an additional $1,000 if you're over 50, and then in the 401k, if you're over 50, an additional $7,500. So with their employer plans, the default is that your contributions are all pre-tax, like we talked about. That comes deducted right from your payroll, and that lowers your overall taxable income. And many plans do actually offer a Roth option within your 401k. So what this means is there's no income limit for eligibility. It just means you can make those after-tax contributions right in your 401k. So definitely check that if it's an option in your plan. And then something to note there is you're likely getting an employer match of some amount. That match will always still remain pre-tax. So what if you're over that income limit? This is another strategy here. In addition to possibly making Roth contributions in your 401k, again, this might not necessarily be recommended if the goal is to lower your taxable income right now. You want to make sure you're contributing the max pre-tax first. But what you may have heard of before, somewhat of a buzzword, is the backdoor Roth IRA contribution. How does this work? There are some strict rules to it. So we could have a whole other video about this. I'm not going to really dive down, but basically, if you have no pre-tax IRA assets, $0 in a traditional IRA, you can have whatever in your workplace plan, but you can't have anything in a traditional IRA to make a after-tax contribution, which becomes a backdoor Roth IRA. Why this is because it kicks in the pro rata rule. So when you go to convert this after-tax amount into your Roth, it's going to first take into account any of that pre-tax money, and it will become taxable to you right away. So it's something to be careful of. But if when that is done correctly, it is another powerful strategy. I know that was a lot of information, but I hope I was able to give you additional insight into how Roth IRAs work, where they can work, and how beneficial they are if it makes sense for your portfolio. So any questions, please do ask us, but we're always looking into these strategies within your plan in our regular reviews as well. Thank you.